Welcome to Beyond the Chart, Module 1.4. I'm Russell. In the last video, we looked at liquidity and the spread, why some stocks are calmer than others. Now let's look at how you actually place a trade. To take part in any of this, you need a brokerage account, the thing that sits between you and the market and actually executes your orders. There are two basic flavors, and the difference matters more than people realize until it costs them. A cash account is exactly what it sounds like. You can only trade with money you actually have. If you have £1,000 in the account, you can buy £1,000 worth of stock. No more. Simple. And it has a built-in ceiling on how much damage a bad trade can do because the ceiling is your own cash. A margin account lets you borrow from the broker to trade with more than you actually have. Put up £1,000 and depending on the broker and the stock, you might be able to control £2,000 worth of position. That sounds like free upside. It isn't free. And it isn't only upside. The effect runs in both directions, and it isn't gentle about it. A 10% move against you on a position twice the size of your own cash is not a 10% loss, it is a 20% loss. And if the broker demands more cash to cover that at the same moment, you can be forced to sell into the worst of the move rather than waiting it out on your own terms. Margin doesn't change what a stock does, it changes how much of an effect that has on you. Once you have an account, you need to tell it what to do. There are two basic order types worth knowing cold before anything else. A market order says buy or sell this right now at whatever the best available price happens to be. It will fill almost always instantly, but you are accepting whatever price the market is offering at that exact moment, which in a fast-moving or thin stock might be noticeably worse than the price you saw a second earlier. A limit order says buy or sell this, but only at this price or better. It might not fill at all if the market never gets there, but if it does fill, you know exactly what you paid or received. There is no universally correct choice between the two. It depends on whether you care more about certainty of execution or certainty of price. In a liquid stock, you can often have both. The gap between them is small enough not to matter. In a thin stock, you usually have to pick one, and picking wrong is how you end up overpaying without ever quite noticing it happened. In the next module, we will look at who is actually in the market and what each of them is trying to do, the players. The full course is on School, all the modules and the community. Link in the description. If this resonates, please like and subscribe. It helps more traders find their way here. The lark cycle is the destination. The journey starts here.